Welcome to The Explainer. So glad you're joining us because today we are unpacking an absolute financial mystery. We're looking at Q2 Holdings, ticker symbol QTW. Normally when you dive into a raw data dump, the story jumps right out at you, right? A company is either clearly thriving or it's clearly struggling. But QTW, it's throwing us a massive paradox. Okay, let's just dive right in and decode what the market is actually trying to tell us here.
So let's start right at the scene of the crime. Negative 37.42%. That is Q2 Holdings' year-to-date return. I mean, if you're a shareholder logging into your portfolio, that is a brutal number to swallow. The stock has just taken an absolute beating this year, completely diverging from the broader market. And naturally, right, when you see a stock down nearly 40% in a single year, your brain immediately goes, okay, the underlying business must be collapsing.
But then you turn the page in the financial filings and wham, you get hit with this whiplash, 470.58%. What is that? That's their net income compound annual growth rate over the trailing 12 months. Like, how on earth does a stock price just plummet by 37% while its net income is practically exploding by nearly 500%? That right there is the exact paradox we're solving today. To get to the bottom of this, we're going to walk through the data step by step. We'll start with the Q2 Holdings paradox, move into valuation to see if the price is right, check out their hidden growth engine, pop the hood on health, debt, and efficiency, and then wrap up with our final verdict.
All right, Section 1. The Q2 Holdings paradox, making sense of the chaos.
Moving to Section 2, valuation. Is the price right? Measuring risk versus reward. So we're looking at a stock trading right around $45.16. But catch this. Its 52-week high was all the way up at $96.68. That means it is trading at a staggering 53% discount from its recent high. The market has just aggressively repriced this downward. So the big question is, did the market overreact, or do they know something we don't? Before we look at the exact numbers, let's just quickly touch on margin of safety. We all know it's the difference between a stock's current market price and its intrinsic fair value. It's basically your cushion, right? If fair value is $100 and you buy it for 50, you've got a 50% margin of safety. If your growth assumptions are off by a bit, that cushion protects you. So how big is Q2O's cushion right now? Well, here is the absolute core of the bull case, 75.51%. According to the discounted cash flow models in the data, Q2O actually has a fair value price of $184.42. Since the stock is sitting way down at roughly $45, that current margin of safety is a massive 75.51%. I mean, that is a gigantic cushion. The market is pricing the stock like the business is dying, but the cash flow models, they're screaming that it's actually incredibly valuable. And when we look at the enterprise value ratios, a really stark trend emerges. Check this out. While EV to EBIT has gone up a bit compared to its 3-year average, EV to EBITDA has compressed from a 3-year average of about 108 all the way down to just 20.53. That's an 81% drop, and EV to sales down nearly 39%. So what's the takeaway here? The underlying business is generating earnings and sales way, way faster than its enterprise value is growing. Those multiples are just compressing aggressively.
The PE ratio gives us even more context. It's currently sitting at 41.43. Now sure, in a vacuum, a PE of 41 might seem a bit rich, but you've got to zoom out. The 3-year average PE for this stock was a staggering 194.57. So a drop of nearly 79% means this company isn't just getting cheaper because the stock price cratered, it's getting cheaper because the earnings, are finally catching up to the valuation. The company is literally growing into its shoes right before our eyes.
And then we have a PEG ratio of 0.10, which is highly, highly notable. Measuring the valuation against its expected earnings growth rate, we know a PEG of 1.0 is considered fairly valued, right? So a PEG of 0.10, that is an incredibly bullish signal. It tells us that relative to its expected earnings growth potential, the stock price might be drastically mispriced by the market right now. Which brings us to Section 3, the hidden growth engine, cash flow versus top line.
So why exactly are all these valuation multiples shrinking so fast? Well, it's because right underneath a relatively boring top-line revenue number, a highly efficient cash machine is waking up. Over the last 3 years, revenue has grown at a predictable 12%, which is nice, sure, but nothing crazy. But look at net income. It's grown at nearly 42% annually. And the real kicker, free cash flow. It has grown at almost 124% per year over the last 3 years. The underlying cash generation is just radically outpacing the standard revenue growth. They're getting unbelievably efficient at turning those existing sales into raw, hard cash. And you know what happens when a company starts generating free cash flow like that? It drops straight to the bottom line for shareholders. Connect that massive cash flow growth to their trailing 12 months, and you see earnings per share surging 437.05%. This right here is exactly why that PE ratio compressed so fast. This is the hidden engine we've been talking about. All right, Section 4, Health, Debt, and Efficiency, looking under the hood. Okay, so we've seen this massive growth on the bottom line, but let's do a quick reality check. Are they mortgaging their future just to juice these numbers today? The data says no. Actually, they are deleveraging. The debt-to-equity ratio sits at a super manageable 0.50, and that's actually down nearly 46% from its 3-year average. They're actively paying down debt relative to equity. Now, the current and quick ratios are both sitting at 0.93. Obviously, you'd ideally want liquidity ratios above 1.0 to know short-term obligations are easily covered, so 0.93 is slightly tight. But honestly, when you pair that with their exploding free cash flow and a really low overall debt burden, it's definitely not flashing a red danger signal.
Now, check out this incredible whiplash in their efficiency metrics. Across the board, Q2 has completely flipped the script. Return on assets went from a negative 2.73 3-year average to a positive 5.62. Return on equity flipped from negative to a healthy 12.08. And return on invested capital from negative to 7.85%. Management has effectively stopped burning cash and started actively generating really solid positive returns on the capital they're deploying.
And to really sum up this efficiency turnaround, their net profit margin has officially climbed out of the negative territory of its 3-year average to a solid positive 3.51%. They have finally crossed that profitability threshold. That steady 12% revenue growth we talked about earlier, it is finally flowing cleanly through the business model and dropping straight into actual profit. Which leads us to Section 5, the final verdict, weighing the evidence.
Looking at all this raw data, the bears are definitely in control of the price right now, right? They've pushed it down 37% year to date, and they'd probably point to those liquidity ratios sitting slightly under 1.0 as a reason for caution. But on the flip side, the bulls have an incredibly loud fundamental argument here. A massive 75% margin of safety based on discounted cash flows, a PEG ratio that's practically touching zero, and a free cash flow engine that is consistently compounding at over 120% a year. The contrast between these two sides is just stark.
So that leaves us with the ultimate question. Look at this stock sitting at $45.16 today. Is Q2 Holdings a value trap, where the market is totally right to price in a future slowdown? Or is this a genuine hidden gem, a cash flow machine that Wall Street has just fundamentally mispriced, giving you a massive 75% margin of safety? The raw data has laid out the paradox, but it's really up to you to decide how the story ends. Thanks for joining me on this explainer, and as always, keep digging into the numbers.